This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Business Week podcast with Carol Messer and Tim Stenivek from Bloomberg Radio.
The retail sector, which continues to come out with earnings. Macy's, Lowe's, and Dick's Sporting Goods all reporting shares of Macy's getting slammed. Comp sales beat, but a significant drop from a year ago shows that department store customers are pulling back on purchases. CEO of Macy's pointing to ongoing macroeconomic uncertainty and talking about promotions, quote, surgically implemented.
Sounds like precision.
This cannot be good to clear out seasonal items. Dick's plummeting. Lowe's, though, rallying after second quarter comp sales and quarterly profit beat average analyst estimates. A lot going on, Tim.
Yeah, with us, we've got a great group. Bloomberg Intelligence senior retail analyst Mary Ross Gilbert joins us on Zoom in LA, and Bloomberg News reporter Simone Foxman here in our Bloomberg Interactive Brokers studio. Simone, I want to start with Dick's and talk a little bit about this issue that we heard from Target last week. Not just about the consumer pulling back, but about shrinkage, the industry term that's used for theft, employees stealing, or damaged goods. What's going on?
I mean, it seems like a very large contributor to their earnings this quarter. And we had this with Target last quarter. Back in May, Target said it was cutting its overall estimate for profits by $500 million because of shrink. And what Dick's was saying here on the earnings call today was simply that they had not planned for this level of shrinkage. They normally get a bit more shrink and account for it around the back to school season. But this is more, they said it's a really big problem and that they're doing everything they can to kind of combat it. But I think this echoes some of the other concerns that we've heard from retailers. I think one thing that maybe this is what we're seeing in some of the trading today, it was just such a large issue. And last time when we heard Target talk about the impact overall, it was just such a surprise to people. I think that it was way larger than considered, and maybe that's why we're looking at shares.
Maybe they should put some security tags and things.
No, but that's actually a perfect segue for Mary Ross Gilbert. It's what I brought up on the simulcast a little earlier, Carol. And not to step on your feet, but I mean, the fact is if you make the changes within a store to prevent theft, there's a certain point where there creates so much friction between the consumer experience, a consumer actually trying to buy something, that it's not even worth going to the store anymore. Like trying to get deodorant and shampoo and toothpaste from a CVS behind plastic. So Mary, weigh in on this. What do you think of this, Mary Ross Gilbert, with the idea that, I said the big winner with shrinkage is e-commerce because there is so much friction now with actually going into a store.
I would agree with you there, but on the digital side, Macy's was down. And actually, Macy's called out shrink. They just didn't call it shrink. They called it shortage. It kind of confused investors at first on the call, but they quickly caught on, oh yeah, they're talking about theft. And that's exactly what it is. And look, we've been hearing about it in the news every week. We're hearing a group of grab and go theft going on, and it tends to be along the luxury line. So Bloomingdale's, in fact, our Bloomingdale's right next to our building here, the Gucci boutique there was robbed, I think about 3 weeks ago. So there's definitely a lot of that activity going on, and Macy's called that out also on their call. It didn't affect their margins this quarter. They have sort of budgeted for the shrink issue, but it's definitely it's something that they guided to for their third quarter as one of the factors, as well as the weakness in the consumer and the fact that they saw higher debt expense, and that's associated with higher delinquencies. They were planning for it, but it's much higher than they planned for.
It feels like we're all of a sudden talking about shrinkage a lot, but I went back and just kind of did a quick Google search, and back in 2015, Bloomberg did a whole big story about shrinkage at everything from Dollar General, AutoZone, Whole Foods, Bed Bath & Beyond, and then, Walmart. So it's been an issue that's out there. It sounds like you want to jump in.
Yeah, it's hard to, I think one of the challenges we've had, and certainly the challenge the print team has had as well, is determining how large this impact impact actually is, because yes, people are blaming shrink for things, and certainly in California the laws have changed in a way where the law doesn't punish theft up to a certain level, and that seems to encourage some degree of shrink overall, of theft overall. But no one can kind of tell. I mean, one thing, Tim, you were talking about how creating this atmosphere where people are worried about safety in stores pushes people to online. It's interesting because at the same time, we're seeing Macy's, we're seeing Dick's really invest in trying to get people back into stores, whether it's with Dick's and House of Sport or Macy's with its smaller, more boutique-y elements.
We talk about that a little bit because Dick's has actually just crushed it since the pandemic. I mean, the stock is up 650%, even with today's decline since March of 2020. And a big part of that is because of the huge investments that the company has made in this experiential element. So what can people do in Dick's stores that, they can't do online?
I think they're like rock climbing walls, you get special customer service, essentially engaging with the customer in a way that is not possible online, right? There's already an incentive to try and go to stores if you need a specific size. You don't know what shoe size you are, you really have to go to figure it out. Instead, you're going to order multiple shoes, and then you got the pain of sending them back and stuff. It's trying to create an incentive for people to be in stores. And one of the things we've seen across retailers is this investment into these smaller scale stores as well, to try and get people in.
So I want to go back to those that reported. So let's go back to Macy's for a moment, Mary, because what I thought was interesting is what the CEO said, and I know our team also talked with the CEO earlier on Bloomberg Television, or at least for Bloomberg Television. But these surgically implemented, talking about promotions surgically implemented to clear out seasonal items. That says to me some like over inventory. So was that just bad purchasing and bad decisions? Like, how is Macy's doing generally?
Yeah, so I think just to clarify the point on surgical, that's actually a good thing. So what he was trying to say is because they've invested in data technology and analytics, they are able to target their promotions more pointedly. And as a result, they're able to move out merchandise more quickly and not take as much of a hit as they would normally have done without that capability. So if anything, that's actually a good thing. And they were able to, clear out that merchandise well in advance of, what they were planning to do. So that is the good news. Yeah, going into the first quarter, they were seeing strength. I think everyone was. We had a good January, and then all of a sudden the world changed, and we started to see the declines, since then, and they've continued. And I think, as Gannett pointed out, I mean, the consumer is also spending on experiences and travel. And then with their 50% of their customers earning $75,000 and under, they're strapped when you think about living expenses being so high. And look, off-price is picking up some share possibly as we've seen, strength in their figures.
I did think it was interesting that the Macy's CFO saying credit card delinquencies accelerated in the second quarter, particularly in June and July, which negatively impacted results. We've just got about 25 seconds left for Lowe's. What do we need to know?
Housing, a little bit stronger than everyone anticipated, and contractor division especially kind of strong.
Is that because people don't want to move and they want to renovate instead?
This has been the question, right? It's a little unclear at this point. Contractor was stronger for Home Depot as well.
Which is more important to the Home Depot's business, isn't it?
Exactly. Home Depot's split is 55-45, whereas Lowe's is 75 DIY to 25. Typically. But this is interesting, right? Maybe people are stuck. Maybe they're spending more. It's hard to get a sense whether this is a long-term trend yet because the dynamics are moving so quickly, but there is an undersupply of homes.
I will say Lowe's is up 3.6%, so definitely an outperformer.
The one good one. Yeah, I know.
Exactly. There's not a lot. Simone Foxman here in our Interactive Broker Studio, reporter at Bloomberg News. Thank you. Mary Ross Gilbert, our thanks to you as well, senior retail analyst at Bloomberg Intelligence on Zoom from Los Angeles.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
One of my favorite moments of our broadcast was Ira Jersey, our interest rate strategist here at Bloomberg Intelligence, talking about, was it on the live blog, right? And he, I said, what's more important to you, NVIDIA or Jackson Hole? And I'm assuming he's going to be like all over Jackson Hole. And he talked about on the blog saying how people, though, were talking about the importance of NVIDIA this week.
Yeah, it's funny.
In
Ben
his
Emmons,
world, right?
Ben Emmons over at New Edge Wealth, who listens to us, he sends a newsletter, he watches us. He just sent me that story, how NVIDIA's Jensen Huang may be driving Fed rate hike expectations.
I just think it's interesting that focal point. So anyway, this is why we wanted to talk about it. I don't always love to do previews, but I felt like this was really important, and especially when you've got somebody like our own Bloomberg News U.S. Semiconductor and Networking reporter Ian King, who knows this space so well. And Ian is, of course, joining us on Zoom from San Francisco. Ian, we did see NVIDIA, which has been on a tear certainly this year. I just want to pull it up to see how it closed today. It was down about 2.8%, but it did hit another intraday record today on expectations that things are going to be pretty good when it reports after the close tomorrow. Remind us why this is such an important focal point.
Well, if you believe in AI, if you believe that this is the future of computing and that it's going to revolutionize so much of the economy, then obviously, well, who's going to profit from that first of all? And, the company, arguably the only company that's really shown a demonstrable impact from it already is NVIDIA, because the chips that they provide are absolutely central to the training of all of that software that's going to do all of these magical things, so we're told.
Do you believe the hype?
I believe the numbers.
Okay.
The company this quarter is on course to report quarterly revenue that just 2020 was annual revenue. So clearly there's been a rapid acceleration there. It was a company that was a niche. Now this data center business is absolutely huge, and the majority of its business, whether that's sustainable or not, we'll get a window into tomorrow, obviously. But in terms of proving, hey, look, here's some real numbers, we've done something, it's absolutely there. Ask me about AI in general, and I might have a different answer.
Well, we may get there, Ian, later in the program. We did just show a chart of NVIDIA stock up more than 200% so far year to date, Ian. What is it that makes NVIDIA different? What's the company's moat? And does it have any true competitors?
They have competitors who are wildly chasing them to try and catch up. The company's moat is that they saw this coming. I mean, a few years ago, a company that was making gaming chips started talking about accelerated computing, started talking about this being a thing. And everybody was like, really? Are you sure? They had, the CEO was talking about how many people were at universities were training on his software. Every earnings quarter, we'd like, yeah, we've got this many universities now teaching people this CUDA program. And again, Wall Street was like, well, what's going on here? Why do we care? Now, fast forward to where we are right now, everybody's using their chips, everybody's using their software, because that software allows a form of computing to happen that was previously very, very difficult, very time consuming, and very expensive. It's still expensive, but now it's possible.
I mean, at this point, considering all the conversations and all the reporting that, you and just kind of our overall team have done about the excitement of AI in general, one would assume that their numbers have to be blockbuster, right? Or is there something in the cycle that companies will buy some chips and then there'll be a little bit of a lag and then they'll buy some more? Help me out and help me understand so that I'm hopefully somewhat smart when they report tomorrow.
No, you've nailed it. That's the perfect question to be asking ahead of tomorrow, because and if you read the analyst reports, they're all over the place. Why are they all over the place? Well, 3 months ago, Wall Street got embarrassed, right? 52% ahead of what the consensus number was, right? Was the projection that NVIDIA gave. Wow, right? So what's happening this quarter is all of the analysts are struggling. Well, is it going to be that strong? Is it going to be stronger? Is the projected range going to be even stronger than that? And the answer is they don't really know, because you could actually explain how strong NVIDIA's numbers are, and this is according to Bernstein, by just looking at the spending of just 4 of these big hyperscalers, of the Microsofts, of the Googles. You factor in all of the others, it could be even bigger. The gating factor on the flip side is back to supply. Did NVIDIA order enough chips? Were NVIDIA as ambitious as they could have been to capture all this? Because you remember, you get chips about 4 months after you order them, and they outsource production. So their estimates of what they could do are going to be the gating factor here.
So when I think about, like, I love our supply chain function, or supply, like, right, who are the customers, who are the
SPLC on the Bloomberg terminal.
SPLC.
I love it. But the supply chain management, I mean, NVIDIA's got to be on top of it, right? To make sure that they can actually meet all the demand that's out there.
Yeah, I mean, the good news on that end is that the PC market still isn't great and the smartphone market still sucks. So TSMC isn't devoting as much silicon to those customers. So that, in theory, frees up this extra capacity for NVIDIA's what it calls accelerators, which everybody's buying right now. As I said, the gating factor is how well did NVIDIA see this coming? Yeah. The orders that they put in 3 months ago that they're going to get chips for now, just how much did they order? Is it enough?
So what can NVIDIA tell us? What can company executives on the call tell us about demand?
Yeah, I mean, there's a lot of mixed signals right now. General data center demand, it's not great because everybody's spending on AI. PC demand, which is another huge market for them, that's not great. We don't have that many strong expectations for that part of their business. What will be interesting, I think, and this is what NVIDIA has been very careful and I think very sort of perceptive in what they've done, is to try to spread the use of AI beyond these so-called hyperscalers, beyond the Microsofts, beyond the Googles, beyond the Facebooks. And they're trying to basically embed the use of this technology into the economy at large. Still early days there. People will be looking for signs of that kind of spread, of this becoming a more sort of baked in part of the economy. And that's back to your earlier comments. I think if they can show progress there, then the excitement can continue and it won't just be a factor of what Google is spending every quarter.
So what does that look like when we actually see AI spread throughout the economy beyond these hyperscalers?
I mean, initially for NVIDIA, it looks like companies that you wouldn't expect to be direct users of NVIDIA's technology becoming exactly that. So you have maybe pharmaceutical companies using accelerated computing for drug discovery instead of using the traditional methods to get the approval that they would go through the experimentation progress. Maybe we do it all on a computer. If they start ordering in a big way, it's spread into that side. This is an affirmation of NVIDIA. This isn't just a one-hit wonder. This isn't a one-use thing. So we need that kind of use case to emerge and to become embedded, and for that to become a significant part of the spending.
I mean, that goes into the euphoria side of it, right? Like, if this just permeates in terms of the AI, the generative AI impacting everything that we do, I mean, man, off and running.
Right. I mean, it's you've seen the stories, we've written them ourselves, and you've had these conversations. Are we at the beginnings of the internet here, where pets.com and everybody else got a wild valuation that was based upon nothing? Or are we at the beginning of something which is more profound and more, going to be much deeper embedded in economic activity? Obviously, NVIDIA is arguing that that's the case. Some people who are concerned at the valuations are saying maybe this is a fad.
Ian, I asked you earlier about, who competes with NVIDIA. You said competitors are chasing them, and the difference with NVIDIA is that NVIDIA saw it coming. But who are its closest competitors right now? I mean, is there anyone? Can you name them?
Two companies, AMD, obviously another graphics maker. They have a directly comparable product to NVIDIA that's coming in the fourth quarter of this year. We'll see just how quick the uptake is on that. They've given strong projections, so we'll see. And the other one is obviously Intel. They already are in this market. But again, software, how easy it is to use what they're going to provide, because NVIDIA has made what they provide very easy to use, very just plug and play as far as the industry is concerned.
You're incredible, as always. Ian King, Bloomberg News U.S. Semiconductor and Networking reporter, just knows everything about
Ian, what are
this
you doing
space.
tomorrow?
Get some sleep, buddy.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Perhaps you're like me, and in your wallet, you've got a couple of different health insurance cards. One is for your medical insurance. It's the one you give to your doctor's office. The other one is for your prescriptions, which you present to the pharmacy when you pick up a medication. That prescription one could be for a pharmacy benefit manager, also known as a PBM.
Yeah, PBMs. Come on, you know what they are. They
Do you?
Well, this is why you and I are.
Do you know what they are?
We have been talking about this so much off air. They negotiate cheaper prices for employers and health plans. They also pocket drug makers' cash, which you maybe didn't know about. They're under fire from all directions right now. Blue Shield of California last week saying it would replace some drug procurement services from CVS Health's Caremark PBM with an amalgam of rival offerings, and that sent shares of CVS sliding. We all kind of like stood up a little straighter when that headline crossed.
Yeah, that was a big one. And then officials as diverse as FTC Commission Chair Lena Khan and Florida Governor Ron DeSantis, they want more transparency from them. There's a story about PBMs and how they grab extra cash for themselves from the very parties they're supposed to be playing hardball against. It's in the upcoming issue of Bloomberg Business Week. It's on newsstands later this week. It's already online, though, at bloomberg.com/businessweek and on the Bloomberg terminal. With more, we got the author of the story, John Tozzi. He's Bloomberg News healthcare reporter. Also here is the editor of Bloomberg Business Week, Joel Weber. He's in our Bloomberg Interactive Brokers studio. Joel, when I saw there was a story in the issue of Bloomberg Business Week about PBMs, I immediately just thought it was related to last week's news about California, Blue Shield of California, saying, hey, we're going to go with Mark Cuban's startup. We're going to go with Amazon's startup. But the story's much bigger than that.
Yeah, well, I just had no idea how lucrative it is to get between you and your prescriptions, and it turns out that we're not alone in how that feels like a big deal, and that even places like the FTC, Federal Trade Commission, has also shown an interest. John has been on this for a while and has kept me abreast of his interest in it, and so I was really glad to see it. But how does this break down, John? Because the very people who are supposed to be keeping our drug prices affordable maybe don't have my best interests at heart.
Yeah, so this has been an issue in...
Go figure.
You were just, you look like somebody that we could, take advantage of.
I'm sorry, John.
This has been an issue in the industry for a long time. People who followed it know about rebates. So basically what happens is you go to the pharmacy, you fill a prescription, your health plan pays the full dollar amount of that prescription. And then after the fact, at some point, the drug manufacturer, the pharma company, sends a rebate for part of the value of the drug to your pharmacy benefit manager. And the pharmacy benefit manager sends part or all of that rebate back to your health plan. And this is something that has been debated for years, how much of the rebate gets passed through. Employers and other people who pay for healthcare have said, we need to have 100% of the rebates passed through. There's been this increasing pressure to kind of get all this money coming from the drug makers back to the people who are ultimately paying for the drugs.
Why are there rebates?
Good question. I don't know if we have time for it here, but this is sort of a system of payments and complexity that has built up over years. One, what the PBMs say is that they lower drug prices by getting these, they lower net costs by getting these rebates and other discounts from the pharma companies. They aggregate buying power, they aggregate demand, and they can go to the table with pharma and say, give us money back on these drugs. So the question is, where does that go, and who really benefits from it?
Okay, so Tim mentioned that there are some new players around. How is this going down within the industry? Like, this does seem like that there's an opportunity here to maybe take advantage of consumers, but there are other approaches that are out there as options, right?
So, one thing to know is that there's been a tremendous amount of consolidation in the market over the years. So there are now 3 main PBMs that control about 80% of the market.
Which I hadn't realized have been around since the 60s. I don't know why I thought it was a newer thing, but forgive me. Go ahead.
Yeah. And they're also, like, those businesses are integrated with much larger companies that also own health insurance companies. You have CVS Health, which owns Aetna, United Health, which owns Optum Rx PBM, Cigna, which owns Express Scripts PBM. So they have their arms in a lot of different businesses that are all related. There is growing competition in the PBM market. There are a lot of new entrants, a lot of new tech-focused companies that say they're making more transparent offerings, but they're very small, and what traction they're getting is still to be seen, because those three big players still dominate the market.
Do you need a PBM?
The industry says that employers are not forced to contract for PBM services, and they choose to do so anyway. And that's their position. I think realistically, there's not a clear alternative right now. If you're providing prescription drug coverage, this is sort of the avenue to do it. But with the Blue,
how did it work before they became so dominant?
In the 1960s or before? I
don't know. Have PBMs always had a role here?
Well, I mean, one thing is, the role that prescription drugs play in healthcare has grown incredibly in that period, right? There are more new drugs, more expensive drugs every year. In the 1960s, I don't have it in front of me, but the prescription spend was, much less than it is now. So part of this is like an evolution to, new innovation on the pharma side. That's very expensive here in the United States, where we have a free market for healthcare, and the drug makers can set their prices as high as they want. And so this is sort of an industry that's evolved in response to that. But there are increasing questions around how it actually works, and whether they are whether their clients, the employers, are fully capturing the value of the discounts that they get.
Okay, so FTC has waded into this and subpoenaed affiliates of PBMs called group purchasing organizations.
Yep.
I don't usually think of the FTC and drugs being in the same place. I think usually more like kind of big tech crackdowns. But what is the FTC's interest here?
So the FTC has subpoenaed the PBMs themselves, and then these affiliates, the group purchasing organizations, as well. I think as a competition regulator, they have, and particularly under Lina Khan, they have sort of taken a close look at this industry. They're doing what is essentially a study of competition. So it's not. It's not an enforcement action. They're kind of gathering information and will presumably produce a report at some point. But again, there has been a tremendous amount of consolidation in the industry, I think, and these are companies that have a lot of influence over what drugs are available.
Well, and I also feel like rebates is a loaded word. It just sounds like I'm getting a rebate. Like something's got to be good about it.
But when I hear rebate, I think to myself, okay, this is, a way to get you to buy something with the hope of you not actually cashing in this rebate.
Well, the thing about a rebate is by the time you get it, you've already paid for it, right? That you're not, it's not an upfront discount, although there are those two. It's, so, and then what happens to those dollars when they do flow back to the plan? How much goes to the actual patient who paid maybe the full cost of the drug if they have a high deductible?
That's what I wanted to ask you. Executives from the three big PBMs, this is in your story, said that they pass almost all the rebates they receive from drug makers back to clients. But we don't really know that, do we?
Well,
or do they?
They say they do, and in some programs, like in Medicare, there are regulations around requiring them to do that. But the other thing that we've sort of come to learn is that even as they say they're passing back almost all of the rebates, or all the rebates in some cases, there's other money they are getting from drug makers that is not called a rebate. So it's called a manufacturer administrative fee, or an inflation protection fee, or a data fee, or 5 or 6 other different terms that show up in the contracts.
Is this like my cell phone bill? Is this what this is like? Like all these crazy little bills? Anyway,
so
it sounds like it.
Well, right, and so I mean, one of the questions employers have is, how much money are these companies making from pharma companies, and it's money that is tied to the prescriptions that you and I are filling, right? And so where does that go? And that's sort of the big unanswered question in all of this.
Where does it go?
Where does it go?
Yeah. There is a bipartisan interest in perhaps regulating this space. Is this one of those areas that everyone in DC actually gets along about?
I think there is a lot of agreement. We've seen bipartisan bills both in the House and in the Senate from several committees. One thing, just the political context here is, last year in the Inflation Reduction Act, that took kind of a big swing at pharma because Medicare will be able to negotiate drug prices for the first time. And PBMs are sort of kind of next up in a way that, Congress has been looking at this industry pretty closely, and we'll see if there's action on that in this session.
I thought it was really interesting, too, that it was noted, I think it was a quote from somebody in the story about how these fees that these PBMs get, that they're tied to the price of a drug, even though the process doesn't matter if the drug costs $20 or $2,000.
Yeah, that's one of the really interesting things about this whole business is like a lot of actors' fees are tied to a drug's list price. So, the argument is that if your fee is tied to the list price, then you make more money on higher priced drugs. So you have incentives to cover and sell and promote higher priced drugs.
Ozempic, anybody?
Right.
Or, pick your list, right?
Wegovy. Hey, John, I wanted to go back to what happened last week when Blue Shield of California said it was going to replace some of its PBM reliance. So it was using CVS Health Caremark, the PBM, for pretty much everything. And now it's going to use those upstarts that Joel mentioned, Mark Cuban's Cost Plus Drugs, something from Amazon. How closely is the industry watching this? Because we saw a lot of stocks move south as a result of this.
Yeah, what's interesting is that Blue Shield of California is using some newcomers. It's also still using CVS
for those specialty
drugs, which is maybe half or more of its pharma spend. So, and it's also using another PBM called Prime Therapeutics that has a relationship with Cygnus Express Scripts. So they are doing something different. They are not totally disentangling them from the existing system.
So does that essentially tell us that, okay, the future of PBMs could be in specialties?
That is definitely a growing area, both of, for drug makers and for PBMs, kind of high cost drugs that are called specialty, although the definition around what is a specialty drug and what isn't is a little fuzzy sometimes too. But yeah, that is a place, when you listen to these companies, that is a place where they are growing, and they have clinical programs around specialty drugs, and they're making more and more of their profits there.
Okay, John, you know this space incredibly well. You're always all over it. Tell me something that you learned while you were working on this one.
I had actually not seen some of the contract language that we uncovered for this story, and it is pretty revealing to look at. We looked at a contract between Express Scripts PBM and one of its clients, where they say, we contract with pharma companies for our own account, and we may make positive margin on those relationships. So they are disclosing that to their clients. So what they're not, what nobody really knows is like how significant is that to their business.
And it makes me wonder, as the cost of drugs just keep go up and up and up, like how this potentially plays into all of it. This is why we were obsessed with this story off air. We were even talking about it. John Tozzi, incredible.
Hey,
Thank
Carol,
you so much.
Your rebate's in the mail. Okay.
John is, of course, healthcare reporter at Bloomberg News, as Joel said, just knows the space inside and out. John, of course, in our Interactive Broker studio, along with the editor of Bloomberg Business Week, Joel Weber. Catch this story in the upcoming new issue of Business Week out on newsstands on Thursday, already online at Bloomberg.com/businessweek and on the Bloomberg Terminal. Guys, thank you.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Business Week podcast with Carol Messer and Tim Stenivek from Bloomberg Radio.
Let's get to it, guys. Let's talk about the market trade. Lauren Sanfilippo is Director and Senior Investment Strategy Analyst for the Chief Investment Office at Bank of America, with us on phone in New York City. Big title. Tell me, what is it that kind of from day to day is always on your mind?
Well, particularly for summertime, this has been interesting recently. After a really strong 7 months, right, we've been watching stocks certainly rip to the upside here. It's a little bit of a digestion here in August, so that's making for an interesting August. And rates have certainly been
August is supposed to be, or has of late, right, the second worst month for stocks, September being the worst. So we have seen this trade before where we kind of take a breather in August.
That's right, yep. And so I'm not looking forward to September either. To your point, worst month of the season here, so seasonality.
Lauren, do you think what's happening is fundamental or technical?
I think it's a little bit of both. I mean, so that seasonality is certainly not helping. Maybe a little bit technical too. We've seen those valuations run up, and I think this digestion is a little bit called for.
So if September is worse, how
Buckle
much
up.
worse? Now, how much are you looking for? Like a 10% correction on all the major equity averages? Like, give us an idea. If you look at some individual names, you certainly can see some interesting trends. But what is it that you're looking for specifically? And again, is it technical, fundamental? Is it just what?
I think you could see, I think under 10%, it's not abnormal for markets to be pulling back by that amount a few times a year. So the fact that we've just gone sort of straight up and to the right here on the chart sort of makes for this pullback scenario in September. So I'm weary, but at the same time, we've actually capitalized on some of these pullbacks. We think about buying into the market because, the market really hasn't afforded those opportunities year to date.
Think or do? Think about buying into the market, or do you actually buy into the market?
Well, we're advising clients, yes.
Yeah, okay.
Do.
Yeah, and are they listening, or are they a little nervous too?
I mean, well, you're seeing this year sort of this idea that there are alternatives out there, right? So we have seen some of these elevated cash positions. Money market funds certainly attractive here at 5%. So that's real yield. So there's certainly some yield chasing happening. Yeah, we're looking to just deploy these opportunities now through year end.
Are you at all concerned about what we've heard from retailers, specifically Target, Walmart, what we heard this week with executives saying that the consumer is pulling back a little bit?
I think the tone of retailers, to your point, has gotten a little bit more cautious. In first quarter, we heard some evidence of trading down, but today felt a lot different, right? I mean, we learned that more folks are sort of at different levels of income. They're shopping in big box discount stores. And then more alarming, there's even evidence of shrink or theft for those retailers. So I think that has to be telling you something.
What do you think the theft tells us, the shrink tells us?
Well, I mean, my guess, people steal out of necessity, so that's not great. We're seeing credit card balances also extremely elevated. You hear that from the Fed. So the retailers plus what the Fed has been telling us, it's sort of the same story here, right?
Although it's been happening for years.
It's just at a different scale now, I think, Carol. But I think, like you said, Carol, it's the question of, and Lauren, tell us if you have this data. I won't say it's troubling, but what I would like to know from these companies, I don't want them to lump all these losses together. Like, I want to know exactly how much they're losing just from, not from damage and not from employees stealing, but from customers stealing. Do you get any of that data?
I have not ever seen that data out there, but you'd be surprised how much, in Manhattan and here in New York City, all of the plastic that's up in front of products, you would think shrink would be down, theft would be down. So I think this is sort of, unfortunately, a sign of the times. It's really sort of a cautionary tale in my eyes.
When you look at the equity universe, I am curious, are there certain areas of the market that you think are more interesting when it comes to investment potential and return potential?
Yes, and I think sector-wise, energy complex, July and August has been good for energy. Valuations are certainly some of the cheapest in the S&P. That's not the best reason to buy, but I think a very good reason to own energy is to own them over the next cycle. And they also have some really healthy balance sheets. So I like energy here. And also healthcare, actually, as just a second sector. For its defensive qualities, I think healthcare looks interesting.
Why healthcare specifically?
I think the AI story is additive to healthcare, and I think that's a little bit overlooked. I know we've been talking about the AI story for some time now, but that productivity enhancement that AI can really offer, that seems compelling.
And where do you think the value is added there? Where do who ends up making money when it gets more productive? Because if there is an area that is ripe for disruption, it's certainly healthcare. Ask anyone who's waited, months to see a doctor and then waits hours in the office to see the doctor.
Right. It made worse by the pandemic. It wasn't so kind to healthcare, I'd say. And, telehealth had its sort of moment in the sun when we couldn't go into offices. But you're right to think that sort of healthcare, I think the infrastructure could definitely use an upgrade.
Where don't you want to be in this investment cycle right now?
Well, we've backed away from the ultra defensive areas of the market. And I think, there are some valuations in tech that don't seem so compelling here. But we do like that balance between tech, like I said, AI, that opportunity. Those are some, high quality plays we think that are certainly good for portfolios here.
I know you can't name names necessarily, but when you talk about AI and high quality, give us some themes here, because I think there are some concerns that the AI story is still, okay, well, we believe it's going to be big, but you need to show us that it's actually going to be big.
Yeah, without naming names, I think tomorrow is a big day for AI in an individual stock. But, it's always interesting to see a single company has actually become a big-time macro story. Wow. It's sort of the bellwether, right, of the AI theme. And that's been a very predominant narrative that's played out in equities this year. But I also think it's a really great check on supply chains and, the shortages that we've been talking about since the pandemic.
All right,
You're calling it. That's what Carol's been saying, too. You're like the NVIDIA macro story.
You can say it, not me.
No, really appreciate it. Lauren, take care. Lauren Sanfilippo, Director, Senior Investment Strategy Analyst for the Chief Investment Office over at B of A, on the phone in New York City. I just, concrete. We're all so gaga over AI. If NVIDIA continues to see demand and kind of grow into that valuation, that's a big growth story going forward.
What if it doesn't?
Wah, wah, wah. Get ready for a correction. This is Bloomberg.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.